Hello, everyone. Thank you very much for joining us once again today. Welcome back. This is our third lectures on the transitional provision, and this is the final lectures on transitional provision. In the previous two lectures, we have discussed that the closing balances for the latest financial year will be carried forward as opening balance for your first tax period. Then we discuss what will be the value of your closing balances. Then we discuss the closing balance should be carried forward at the fair value, at the arm length principle, should market value. What is the closing balance? It should be the market value. So what is the reason for this? The core objective was that the balances are being taxed in the respective period. If there is a gain before the corporate tax, this gain should not be taxed after the introduction of the corporate tax law. If there is a gain during the first tax period, this gain should be taxed in the respective tax period. So these two lectures that we already discussed, basically, as I mentioned earlier, we have already discussed two lectures on the transitional provision. This is the third and final lecture. So whatever we have discussed till now, as usual, we have already conducted 28 webinars on the corporate tax, and almost we have covered everything. And you can see, starting from the scope, starting from permanent establishment, application of corporate tax and the partnership, free zones, family foundations and trust, taxable incomes, unrealized gain on assets and liabilities, interest capping rules, deductible expenses, small business relief, tax grouping, tax loss provisions, reliefs, free zone consultation paper, participative interest and its taxation, application of corporate tax and trading companies, application of corporate tax on manufacturing and processing firms, transfer pricing and its importance, small business relief impacts and compliance discussed once again. And last two lectures, it was on the transitional provision where we discussed introductions and arm length principle. In this lecture, we are discussing opting out pre-tax gains. And this lecture will discuss what are gain, basically the businesses opt out, they should not be taxed after the introduction of the corporate tax. Pre-tax area gain should not be taxed after the introduction of the corporate tax law. In this, we'll cover introduction, eligible assets, election, methods to calculate, and then we'll draw the conclusion as well. So introduction, as I mentioned earlier, what the law requires that the closing balance taken from the balance sheet from the latest financial year should be carried forward as an opening balance for the first tax period. These balances should be based on the arm length principle. I told the reason as well. What the reason? Basically, the main purpose of adjusting the balance is to make sure that the gains are being taxed in the respective tax period. Losses are being allowed for the respective tax period or for the respective period. Means previous period gain should not be taxed in the first tax period. Yeah, pre-tax gain should not be taxed in the first tax period. Pre-tax losses should not be allowed after introduction of the corporate tax. So this was the core objective of introductions of the transitional provisions. Moreover, another objective was what is the fair market value? A fair market value should be carried forward. So there should not be any inappropriate impact on the future on the taxable profits. So whatever the value of the asset, what the value of the liability, what is reflecting into the financial statement, it should be carried forward on the market value. So the businesses in the future, in case they're claiming any depreciation, there should be fair and appropriate impact to the taxable profits. So this was the core objective of introduction of these provisions into the corporate tax law. Just this is an example via just discuss what the purpose of introduction. If an asset was purchased in June 2023 and sold in June 2024, the gain on the asset that were earned before the start of the first tax period should not be taxed after the introduction of the corporate tax law. So now the question arises, is the every assets is eligible to opt out corporate tax for the pre-tax era gains? This is the question. No, this question is specifically limited, specifically available to the eligible assets. And these are the 4 eligible assets. First, these are the qualifying immovable property, qualifying intangible assets, qualifying financial assets, and qualifying financial liabilities. So what is qualifying immovable property? Qualifying immovable property is an immovable property that fulfills these 3 conditions. In the same way, qualifying intangible assets, they are the same conditions which are available, which are required for the qualifying immovable property. One more condition is there, that the asset, intangible asset, the life of the intangible asset before entering into the tax era, the life or the period for which asset is being held by the taxable person, this period should not be more than 10 years. Then qualifying financial assets, there are only 2 conditions: financial assets owned before the first tax period. Second, these assets are being measured at historical cost. The same 2 conditions are applicable for the financial liabilities as well. So we can say any immovable property, any intangible assets, any financial assets, any financial liabilities that meets the respective conditions, it will be considered qualifying immovable property, qualifying intangible assets, qualifying financial assets, and qualifying financial liability. So on overall basis, for discussion purposes, we can say these are our qualifying assets. These 4 qualifying assets, and in the respective ministerial decision, businesses, taxable persons are eligible for the pre-tax gain to be opted out for these 4 qualifying assets. So what is the immovable property? Immovable property has been defined in the respective decision. That immovable property means any area of the land for which rights or interests or services be created. Very simple. Any area of land on which you have the right, and you can create your interest. Any building infrastructure attached to the land permanently or attached to the seabed. Any fixture equipment. This is a very common definition of the immovable property. So immovable property, qualifying intangible assets, qualifying financial assets, qualifying financial liabilities. These 4 are the qualifying assets for which businesses can opt out. Pre-tax gain should not be subject to corporate tax. Important thing is, out of these 4 qualifying assets, for the building, it has been given in the respective ministerial decision that these, for person, the taxable person can opt out corporate tax for any qualifying immovable property. If the person has, assuming 10 properties, out of the 10, the person wanted to opt for one, remaining 1, the person didn't want to opt it out, law gives an option, the person can opt out for any qualifying immovable property. In case for other qualifying assets, qualifying intangible assets, qualifying financial assets, qualifying financial liabilities, for these 3 qualifying assets, law says in case the person is applying, it should be applicable for the all assets of the respective clause. Means if the person is wanted to opt out for corporate tax for the intangible assets, all the intangible assets that fulfill this condition, the person can opt it out. For the financial assets, all financial assets that fulfill the condition, all financial liabilities that fulfill the condition. So now we have learned basically for the 4 qualifying assets, the taxable person can opt out the corporate tax for the on the period related to the pre-tax gain. Now, when the person can opt it out, they said the law says whenever the person submitting the first tax return, in the first tax return, the person will opt it out. Basically, elect to opt it out, not opt it out, elect to opt it out, and the specific structure of the return will be there. The option will be given to the taxable person. Taxable person will be able to elect, will be able to opt. Yes, the taxable person wanted to opt this scheme. They need to elect, they need to opt this scheme in the first tax period, in the submission of the first tax return. Once at the first tax return they have elected, then the law says at the submission of the first, in the future, whenever the asset is being sold, the person will be liable to calculate gain and loss, and after calculation of the gain and loss, what are the pre-tax area gain, they will be able to adjust. So adjustment will be at the time of the disposal of the asset. Adjustment will be at the time of the disposal of the asset. Opting out election will be at the time of the submission of the first return. And there are two methods. It has been given in the respective ministerial decision. There are two methods the taxable person calculate gain related to the area before the introduction of the corporate tax law. What are these two methods? One is the valuation method. Second is the time apportionment method. For the valuation method, we have already discussed in our previous two articles that we need to calculate the value by the end of the respective financial year. Whenever these balances are being carried forward, we need to apply the fair value model. We discuss cost less revaluation, less related expenses, whatever. We need to calculate the fair value. We need to hire an expert to calculate the fair value. So whatever the fair value are reflecting by the end of the latest financial year, we need to take that value, and that will be considered. Then we need to compare with the cost. There will be gain. That gain will be considered pre-tax area gain, pre-tax gain. So we know the pre-tax gain, we know the post-tax gain. Pre-tax gain will not be subject to corporate tax, and the taxable profit will be adjusted accordingly. The value method taxable person to exclude the amount of gain that would arise at the start of the first tax period. And you should be then the taxable person determine the market value of the PUA at the beginning of the first tax period. Basically, valuation method, as I mentioned, we need to calculate the value by applying the valuation method. We need to hire expert, calculate the value. This value will be considered opening value for the corporate tax purposes. We need to consider difference in between opening value and cost. Whatever difference in between these two values, this will be considered. We need to consider difference between the market value and the original cost and net book value. This is very important whenever we are considering market value, then cost will be higher of the original cost or net book value. Out of these two, whatever is higher, it will be compared with the market value. Differential will be my gain. This gain should not be subject to tax after the introduction of the corporate tax law. Just look into this example. If an asset was bought at 8.5 million at the start of July 2023, asset has been bought 8.5 million at the start of July 2023. The fair value of the asset was 10 million at the beginning of the tax period. So when the tax period was started, fair value of the asset was how much? Fair value of the asset was 10 million. Asset was bought at 8.5 million. So how much is the gain? How much is the gain? Gain is 1.5 million. Cost is 8.5. Market value, opening assets market value, beginning asset market value, market at the start of the first tax period 10 million. 10 million less 8.5 million, 1.5 million. This is my gain. Upon disposal of the asset at the end of July 2024, it market value of 12 million. So 8.5 million is my cost. Opening market value is 10 million. At the time of sale, asset market value was 12 million. This is my pre-tax gain. This is my gain after the introduction of the corporate tax. This gain should be subject to tax. This gain should not be subject to tax. And taxable profits needs to be, accounting profit needs to be adjusted accordingly to arrive at the taxable profits, because this gain will already be reflecting at the profit and loss account. We need to deduct it from the PAT, profit after tax, profit before tax. We need to deduct the gain, pre-tax gain out of the corporate, out of the accounting profit to arrive at the taxable profits. Second method is the time apportionment method. Sometime if the value of the asset is not available by the end of the immediate financial year. Again, going back to the same example, suppose 31st December 2023, asset was reflecting, and this is the asset as plant and machinery. And this plant and machinery, you can take a building, qualifying intangible property. This asset, qualifying immovable property, we don't know what is the market value of the qualifying immovable property. In case we don't know the market value of the qualifying intangible asset, qualifying financial asset, qualifying financial liability, or any other qualifying asset, if we don't know the market value by the end of the latest financial year, then the option is we need to consider the time apportionment method. How we'll consider it? Whenever this asset will be sold in the future, we'll say how much period the asset was held before the introduction of the corporate tax law, and how much time the asset was held after the introduction of the corporate tax law. Then gain needs to be apportioned in between the time before the introduction of corporate tax law and after the introduction of the corporate tax law. Whatever the gain pertaining to the area before the introduction of corporate tax law, on proportionate basis, it will be reduced and the accounting profit will be adjusted accordingly to arrive at the taxable profits. It's very straightforward and simple. Just looking at the same example again. Assuming we don't know the market value of the asset by the end of 31st December 2023. If we don't know the market value, we know the cost of the asset was 8.5 million. We know the sale price of the asset value, sale value is 12 million. 12 million less 8.5 million, how much? 3.5? 12 minus 8.5, 3.5. 3.5 million is my total gain. Out of this 3.5 million, how much time asset was held before the introduction of the corporate tax law? The asset was bought in July. So July, August, September, October, November, December, 7 months. Asset was bought at 8.5 million at the start of July. July, August, September, October, November, December, 6 months. 6 months before introduction of the corporate tax law, then asset was sold at the end of July, 7 months after the end of July. So total how many months asset was held? 13 months. So gain is 3.5 million, 3.5 into 6 divided by 13. The value is 1.6 million. This is a gain pertaining to the area before the introduction of corporate tax law. We'll discuss two methods. One is valuation method, time apportionment method. Valuation method, we need to do the proper valuation. We know the value, what we can calculate the gain before the introduction of the corporate tax law, and accounting profits needs to be adjusted accordingly to arrive at the taxable profit. Second method is time apportionment method. In case we don't know the market value by the end of the latest financial year, we need to consider the total gain when the asset will be sold. Then we need to apportion this gain in between the time before the introduction of the corporate tax law and the time after the introduction of the corporate tax law. Whatever the gain coming, like in this example, 1.6 million is the gain. This 1.6 million, for this 1.6 million, we need to adjust our accounting profit to arrive at the taxable profits. Important thing they have given for the qualifying immovable property, like in our previous example, at the beginning of the market value was 10 million, that we have observed example, it should be determined by the relevant government competent authority. Important. So it is a qualifying immovable property, the market value, arm length price, fair market value of the qualifying immovable property shall be determined by the relevant government competent authority in the UAE. The special provision for the law for the specific assets, as I discussed earlier, these provisions of the law are not available for all assets. All respective assets we already discussed in the previous articles, previous webinars, how to ascertain the market value. Then this provision is applicable specifically for the four assets, four qualifying assets: qualifying immovable property, qualifying intangible asset, qualifying financial asset, and qualifying financial liability. What is the proposed recommendation? Basically, this is recommended to the eligible taxable persons to opt to adjust the gain in the first return. In the first return, you need to opt. In the first return, you need to elect that you will enjoy, you will take this benefit. And upon disposal of the qualifying assets, you need to calculate the gain and make adjustment to arrive at the taxable profits. So I will summarize this, whatever the discussion, I very straightforward summarize it. These are four qualifying assets: qualifying immovable property, qualifying intangible assets, qualifying financial assets, and qualifying financial liabilities. So in the first column, I mentioned the conditions. These conditions we have already discussed in our previous. Then these are time apportionment, time limitation. There are no time limit. The only limitation for the qualifying intangible assets, the taxable person is not holding this asset for a period more than 10 years before entering into the corporate tax year. All of this, no. For the building, they can taxable person can apply can opt for any building, but for all other, they need to opt for all respective class of the assets. Opt option, first return, we have already discussed this. When to calculate gain upon disposal, this is same for all assets, this is same for all assets as well. So actually gain, how will you calculate the actual gain? Sold at the market value, and the cost should be higher of the original cost and market value. So cost will be higher of the original cost and market value. You know the market value, the differential will be your gain. The same thing applicable for the qualifying intangible assets as well. But for the qualifying financial asset, a qualifying financial liability, you will show at the market value, and the cost will be equal to the net book value. The same applicable for the qualifying financial liability as well. Calculation method, this is important. I have a certain doubt regarding these provisions, but anyway, it has been written in the respective cabinet decision, ministerial decision. Might be there's some different interpretation. Qualifying immovable property, they are giving an option that we can apply the valuation method and we can apply the time apportionment method. Qualifying intangible asset, we can apply the valuation method, and for the qualifying financial asset and financial liability, we can apply time apportionment method. We are always here to help you in case of any impact assessment, in case of any implementation, in case of advisory services, compliance services. We are giving full-fledged services to the business. We are taking starting from point A, startup restructuring, impact on your business, then doing implementation, transfer pricing, all these things, and then we are advising advisory services to clients as well. You can approach me, mahar@crestcooper.com, Faiza, or rest of the team members. We are always ready to listen, understand, and deliver. You can approach us at info@crestcooper.com. You can give us a call as well. This is over from my side. Thank you very much. And if you have any question, you can ask. Okay, this is our choice. If you opt for the valuation method or time apportionment method, please clarify. Yes, law gives you an option, ministerial decision gives you an option, but I will say if the valuation is available, straightforward, take the valuation. If the valuation is not available, then go for time apportionment method. This is my recommendation. Any other question? Yes, you can ask. Can I ask any question? For sure, you can ask. This is applicable on inventory as well. No, this is not applicable on the inventory. They are asking financial asset, financial liabilities, intangible assets. Inventory will fall under financial asset. I didn't think so. We need to check. Anyway, Hasib Qureshi, as the designated free zone is the same or for VAT treatment. Can I know the only designated free zone company can get benefits of zero rated or non-designated free zone company can also get the same? Okay, for the distribution business, you must be based in the designated zone and you can enjoy 0% corporate tax privilege. Other than distribution business, you must be based in the free zone and you must be a qualifying free zone person. By the way, qualifying free zone person condition is applicable for the distribution business as well. So either you are based in the, for the distribution business, you must be based in the designated zone. For the non-distribution business, you wanted to enjoy 0%, you must be based in the free zone, you must be a qualifying free zone person. Any other question? No? Okay, guys. Okay, one more. Till when we can register for CAT? Law requires at any time you can register before the submission of your first tax return. Qualifying free zone person should be based on the designated free zone. No. As I mentioned, any person which is a free zone person, Any person which is a free zone person and that meets 6 conditions, it can be a qualifying free zone person. But the important thing is, for the trading business, for the distribution business, you must be based in the designated zone. Designated zone itself a free zone. So this is the one extra condition for the company which are involved in the distribution business. They must be based within the designated zone. And other than this, companies can be based in the free zone. Then they must meet the requirements of the qualifying free zone person. So any other question? No? Okay, guys. Okay, what about the service industry? Okay, you have any question related to service industry? Some services, if you are in the service industry, you are based in the free zone person, you fulfill the conditions of qualifying free zone person, there are a possibility of generating qualifying income. There is a possibility, but you need to respect the all respective conditions. Okay, Fayaz is asking, can you clear me please, on first phase only LLC and listed company are required to register for corporate tax? Can you clear me please, on first phase only LLC and listed company are required to register corporate tax? Corporate tax is applicable on every person except a natural person having a gross revenue of less than 1 million, or exempted person. Other than this, every person is subject to corporate tax. Okay, guys, take care. Thank you very much. Have a lovely evening. Thank you. Bye-bye.
Thanks for watching the video. Click on the bell and subscribe to the YouTube channel.